Welcome to Stocks That Can Double series, stock number 5. It's Gitlab. Previously, I've done 4 videos on 4 stocks that can double in the next few years, and I'll leave the links in the pinned comments. As usual, I'll walk Gitlab stock through my 5 filters. Number 1 is value proposition. A lot of you already know about Gitlab. It's a competitor for GitHub, which is owned by Microsoft. So it's a DevOps platform, which is a single application that leads to faster cycle time and allows visibility throughout and control over various stages of the DevOps lifecycle. So a lot of us already know it's a primary DevOps platform in Google Cloud, and they also have a partnership with AWS. The second filter is margins. As you can see on the screen, they have close to 90% gross margin, which is phenomenal for a software business. And currently their operating margin is negative because they're still a growth company, but we have to watch the trend. If you watch the trend, the operating margin in Q4 of 2023 was negative 49%, and it's been constantly reducing, and currently it's at negative 21%. So it means that the revenue growth is faster than the operating expenses. So that's what we want for a growth company. We don't want the revenue to grow and operating expenses grow even faster. That means they're buying revenue. But that's not the case for GitLab. So the margins are good. They will eventually become profitable once they scale. The third filter is balance sheet. They have close to $916 million of cash and cash equivalents and almost no debt. So the balance sheet is pristine. The fourth filter is growth prospects. As you can see on the screen, they are growing north of 30% year over year for the past few years. Their growth is primarily driven by their current clients as well as new clients. If you note, they have about 124% dollar-based net retention rate, which means year after year, their existing clients are spending 24% more than what they did in the previous year. So even if they don't add new clients, their revenue will grow by 24%. And I hope they continue this dollar-based net retention rate above 120%. So we are guaranteed 20% growth rate. And we already know that they are associated with Google. So as Google Cloud grows faster and faster, that's going to result in GitLab's growth being faster and faster as well. And they're platform agnostic. Even though most of their company, like 20%, is owned by Google, they are not only confining themselves to Google, they are also partnering with AWS with GitLab Duo and Amazon Q. So they will have better revenue growth opportunity with AWS as well. So that's promising. And also, as you can see on the screen, they also offer end-to-end software development and deployment workflow powered by AI. So that's also going to drive more and more revenue growth for them in future. So overall, I'm confident about their growth potential. They are well positioned. And the fifth filter is valuation. So if a company passes all the 4 filters that I've described before, if it's super expensive, then the returns will not be good, right? So valuation is the most important part in my opinion. So as you can see on the screen, in the reasonable assumptions case, in 2024, they are making about $750 million of revenue. And for the past few years, they have been growing at 30% year over year. So I'm estimating 25% year over year growth on an average for the next 5 years, with which they'll make close to $2 billion of revenue in 2029. And I'm estimating a net profit margin of 30% because their gross margins are 90%. And in SaaS business, if your gross margins are close to 90%, and if you scale and be disciplined with your operating expenses, you can easily achieve 30% net profit margins. And that's the basis for this 30%. With that, they'll make close to $700 million of net income in 2029. And I'm estimating a multiple of 32.5. A business that's growing this fast and has margin like that, people will pay a premium multiple. I think it should be more than 35, but I'm being reasonable and I'm estimating 32.5, with which this company would be worth about $22 billion in 2029, market cap wise. And currently they have 167 million outstanding shares. This company is not profitable. Even though they have close to $1 billion of cash, they are continuing to give out stock-based compensation, etc. So there will be dilution. The dilution has been about 4% for the past few years, but as the company gets bigger and bigger, the stock-based compensation as a percentage of revenue will diminish. So that's why I put 3% dilution year over year, with which they will have 194 million outstanding shares by 2029. When I divide the $22 billion of market cap with 194 million outstanding shares, I get a stock price of 115. Currently they're at $57, right? That's about 102% gain, or a 2x in 5 years, which is very attractive. And let me show you the valuation with great execution, which I don't believe in, but I would be happy if this happens. I still kept 25% growth and 30% net profit margin, but I'm assigning a premium multiple of 40. With that, this company would be worth about $164 by 2029. And currently they're at $57, so that's about 189%, which is almost a 3x in the great execution case. So overall, for my investment journey, I go after the reasonable assumptions case, in which I'm looking at a double in 5 years if I buy this stock at $57. So I'm starting my position at $57. We're still in a high interest rate environment, so I'm going to buy slow. For now, I put close to $1,000, right? So I'm going to continue to build my position up till $5,000 as and when I see opportunity. Let me know your thoughts in the comments. Thank you so much for watching.